Hello, everybody. I would like to thank the organizers for inviting me to this ESG workshop. And today I would like to talk about the question, what use is there in having a good ESG score? And I would like to give some answers from current academic research, from my own research to be exact. Okay, what's my agenda? First, I would like to talk about some ESG basics. Then I will touch on different ESG rating providers, which is a very important question. After that, I would like to talk about ESG and financial performance of a company and ESG and credit risk of a company. Both are very important questions from my point of view. And lastly, I would like to touch upon the question of ESG controversies. And with a summary in some thesis, I would like to end this presentation. Okay, let's start. ESG, what's it all about? Over the last decades, the concept of ESG has gained in importance. As you know, ESG is an acronym for environmental, social, and governance. I regard it as a concrete way of measuring the corporate social responsibility, or let's be even more precise, the corporate social performance, which is not just a philosophical idea, but really something very concrete that you can measure. And the way of measuring it is to use ESG scores. So that's one way of doing that, and the most prominent way, I would like to say. And where do we do this? For instance, or mostly in the context of evaluating the securities, especially stocks of these companies that have ESG scores in the context of investment, for instance. Okay, so that's ESG. Now let's be more concrete about the scores that may be out there. ESG, as I've said, is environmental, E, social, S, and governance, G. And there's something like an overall ESG score, which comprises all of the three dimensions. Yeah. But additionally, we usually have an E score, which measures environmental things, a social score, which measures social things, and a governance score that measures governance aspects. So this makes up 4 scores that we very often have and very often can use. But if we look at this question in more details, we can see that environmental also is made up from several subdimensions, like here, resources, emissions, innovation. And some rating providers really provide also scores on these subdimensions. Like if you have a resources score, that it measures the question or the extent of resource use, or the attempts of the company to reduce the resource use. The same with emissions here. Okay, so these are subdimensions that we have here in the environmental dimension. In the social dimension, for instance, we can have workforce, human rights, community, product responsibility, which are kind of several distinct subdimensions of the social ESG criterion. And these subscores make up the social score here, but they are also existent on their own, so to say, and you can use them in research, which is what we do also. The same with governance here. We have management, shareholder, and CSR strategy here as the subdimensions that we can use. Okay. Now, you may ask yourself which ESG rating providers are out there. There are many. Here I have some prominent, not just examples, but the most important ones, I would say. Bloomberg, for instance, has the most companies they rate. More than 10,000 companies are rated by Bloomberg, also by Morningstar. Here I have some errors, meaning that some brandings that are well known have now merged into this other branding, like KLD scores that you also have used in own research are now have merged into MSCI. Here we have Morningstars, where Sustainalytics belongs to now, and for Thomson Reuters we have Refinitiv and Asset4 scores that are now brands, so to say, under the roof of Thomson Reuters. But we have other examples as well, like ISS, which is not the International Space Station, but another rating provider of ESG ratings. FTSE also is well known, and RobecoSAM also. And you can see here that these providers or issuers of such ratings have a different number of companies they look at, but all of them have several thousand companies. And here's another provider where I could not figure out the number of companies they rate. Vigeo Eiris called, is it called? Okay, so we have used some of these providers in our own research. And for you as a company, for instance, if you are a company representative, you have to know that there are different providers out there. But as you can see, a lot of companies, especially, of course, the stock companies, are nowadays rated with respect to ESG. Okay, now investment point of view is also an interesting thing because sustainable investments have grown over time. Here I have the example of Germany, where I come from. And as you can see here is that the volume of sustainable investments has grown tremendously over the last years. Here I have the years from 2005 to 2019. And here I have the term sustainable investments. This is, of course, not exactly the same like ESG, but ESG is regarded as one and the most prominent concept of implementing sustainable investments. Of course, what do we need? Also, we not only need a company that has an ESG rating, but we need to have a high ESG rating in order to make an investment really sustainable. And we have funds that invest into these companies with high ESG measures. We also have mandates, meaning that there are some asset managers taking care of these sustainable investments. But what we can see here, and the tendency is the same in many other countries also, is that it's really growing. It has grown and it's still growing. Okay, so here we see this, the share of sustainable investments in 2018 in several countries and worldwide also, relative to the total invested wealth. And we see that in Australia, for instance, and also in Canada, Australia and New Zealand and Canada, it's already more than 50% of the total invested wealth that is invested according to sustainability criteria. And as I've mentioned already, ESG is the most prominent concept here to be employed. In Europe, we are slightly below the 50%, and in other countries like Japan and the USA, it's not so much, but it's still growing in these countries also. Okay, ESG as a term is also trending, you could say. Here I show you the graph of Google Trends. and it shows how often this term ESG has been typed into Google. And you can see here also that it's the interest for this term is increasing. This is not only investors, of course. This may also be journalists. This may be researchers that look for these three letters here, ESG. But it's very clear that the trend is also going up very fast. And this means that ESG is simply a concept of major interest nowadays. Okay, now let's get concrete. I will give you an example of how Refinitiv, one issuer of ESG ratings, generates its ESG scores. And you can see here that ESG, as we've seen it before in the first graph, seen something different, but now I introduce these colors and also show you what's behind these scores and sub-scores. So ESG scores of this provider are calculated based on 186 measures collected and calculated from public disclosure of these companies. And for instance, the E dimension here, it's here, E dimension uses 20 measures here to come to a resource use score. It uses 28 measures to come to an emissions score here, and it uses again 20 measures to come to an innovation score. And these scores, the three sub-scores, are then aggregated into an environmental score and so forth. The same in the social dimension. I have an example here for the social dimension where we have the sub-score of product responsibility. And this again is made of the aspects here: responsible marketing, product quality, and privacy. And for instance, just one instance here, in privacy, we have the question, are there privacy statements? And if there are privacy statements, then it's 1, and otherwise it's 0. And several other items go into this privacy. Then we have some measurement of privacy, and for each of these, again, sub dimensions, so to say, and these are then aggregated into product responsibility. And once we have this, we have other sub-scores as well: community, human rights, workforce, that are generated in the same way from publicly available information. And this goes then into the social dimension by some aggregation of these variables. And in the example, we have seen a binary variable, but there are also metric variables out there that are also used, of course. So this hopefully gives you an impression how these scores are constructed from publicly available information, and how there are these sub-dimensions, the sub-dimensions that are measured discretely. Okay. The last step here is then hopefully obvious, that if once we have an environmental score, a social score, a governance score, we can aggregate it into the total score, the ESG score. And that's what Refinitiv and many other providers do. Okay, some more aspects on ESG score methodology I would like to mention. Providers typically update the score of a company once a year because they have to collect a lot of information, and this information is also based on reports of the company, and there are not so many reports during the year. But once a year, this information can be collected, and once a year, typically we have an update. Some providers do not issue absolute ratings, but rather relative ratings or quantile scores, meaning that these so the numbers you can determine here, are then benchmarked, within the industry. For instance, if you have a if you look at the financial industry, look at the bank, for instance, then a bank has a different carbon dioxide emission than, for instance, a company in the utilities industry. And therefore, the emission score would be benchmarked within the industry. And of course, a utility company may have more emissions than a bank, but still it can be very good. And then it has a good rating here. So that's the idea of relative or quantile scores. Okay, some of the providers use mainly binary variables, as we have seen in the example, yes and no, but there are, this was the case of Refinitiv, but Refinitiv also uses metric variables, not just binary variables. And of course, as artificial intelligence is moving on, there's also an increasing use of text analytic algorithms here in this field, because a lot of this information comes from text, like company news that are issued and reports that are issued from the company, and other sources as well, like the media, general media or newspaper. This often is text information, and therefore text analytic algorithms can be used very, very efficiently. Okay, so first important question is, do ESG scores of different providers converge? That's a very concrete practical question for you as a company, for instance. So you have several providers out there. Do they look at your company with the same perspective, and do they come to the same conclusion regarding the ESG rating? Yeah, so that's very important. What we know is that different providers may use a different methodology. Yeah, that's clear. So each provider has other items they are looking at, yeah, and they may have a different aggregation methodology. So that's not always the same what they do. And there may be even different underlying notions of what sustainability is. And let me illustrate that with an example. As an example, consider an automotive company that produces cars. And these cars are conventional cars emitting carbon dioxide when they are used. Yeah. So the question is, which entity is responsible for the carbon dioxide emissions of these produced cars? Is it the automotive company itself, or is it the company that uses these cars? Yeah. What if the produced cars of the one company constitute the fleet of cars of another company that does business, and for doing the business, it needs to utilize the cars, and the staff members of the company drive around with these cars, yeah, and thereby carbon dioxide is emitted. Yeah. So the question is, which of the two companies is now responsible for the carbon dioxide emitted? Yeah, that's a philosophical question, you could say, but it's also a practical question if you really want to measure how bad, so to say, a company is in producing carbon dioxide emissions. Yeah. And let me put this example further to the case of Volkswagen, which is a company producing cars, as you probably know, and it's also a German company. That's why I use it as an example here. And it is also a very interesting example because it's viewed differently by the rating provider MSCI and Thomson Reuters. Here, this is Thomson Reuters, ESG. MSCI says the overall score is laggard, which is not very good. And here we have weaknesses and strength. Weaknesses are here in corporate governance, and corporate behavior. So that's known, I would say. We know that there have been scandals regarding behavior and governance. And it's also laggard here from the MSCI point of view regarding product carbon footprint. So that's exactly the question. yeah, that I was raising here. It's exactly the question. They produce cars, and these cars are then producing carbon dioxide emissions. Yeah, and that's why MSCI says the overall rating is here laggard. Thomson Reuters says, and these are contemporary ratings from last year, says, oh, the overall rating is good because Volkswagen has a good environmental score. It's close to 100. Yeah? This means that they say, okay, the way they produce the cars is obviously kind of very environmentally friendly. They do not emit a lot of carbon dioxide when producing their cars, or at least not so much relative to this industry. Yeah, and therefore they have a good rating here in the E dimension. Also in the S dimension, they are not so good in governance again. So this is kind of the same in this and in that rating. Yeah, but the overall rating is quite very much different. Yeah, and this is not only because of the different methodology. This is also due to the different notion what sustainability in the environmental dimension could mean or should mean. Yeah, and so this is a very interesting example, I would say, where we can take something out of it. Okay, now let's come to a concrete empirical work of my team on the convergence of ESG scores of different providers. We have a study out there. It is published in 2015, where we compare the ESG rating data of more than 5,000 stock companies. And the data we utilize here are ESG ratings. That means E rating, S rating, G rating, and overall ESG. So 4 ratings of 3 different providers, namely Asset4, Bloomberg, and KLD, over the years from 2002 to 2014. And our research question was, are the scores of different providers for the same company at the same year correlated? Yeah, so they should be correlated if they are supposed to measure the same thing. Yeah, are they really correlated? And do they have the same type of fluctuations over time? These fluctuations are mainly the downward fluctuations, like for you as an investor, if you buy the stock of a company with a high E score, you don't want to have the company a low E score in the next year. So that's for you kind of a risk, an ESG risk, that the score is going down in the next time. Yeah, so that's something you don't want to have as an investor, but this happens. And the question was, do these providers reflect the same kind of downward risk when looking at the same company? Okay, and our results are the following. First, there is some positive correlation, but it's not so high as we had expected before. It ranges from only 4%, which is nearly 0, which is not much. Yeah, that was for the E score, the environmental score of KLD, compared to the environmental score of Asset4. There was not much correlation. And it ranges up to 62%. That was for the overall score ESG of Bloomberg compared to that of Asset4. But still, it's not 90% and not 95%. There's still kind of a lot of differences here. Yeah. And we looked, as I said before, on many different companies and their scores. Yeah. And we looked at the question whether this is correlated or not. It should be if it's supposed to measure the same. So obviously it does not measure the same. And we also observed little convergence in the fluctuations over time. So this downside risk question. And the least convergence we could observe regarding the social dimension. So obviously the notions behind what they're supposed to be measured were the most different in the social dimension. Altogether, we can say there are large difference between KLD and Asset on the one side and KLD and Bloomberg, and Asset4 and Bloomberg on the other side. So that's the hugest difference. but Asset4 and Bloomberg are also not identical. They are also quite a lot different. Okay, so now let's go to the question of ESG and the financial performance of a company. And before I present you some empirical evidence on that, I would mention some theories. There are several theories on the relationship between CSP, corporate social performance, on the one hand, and financial performance on the other hand. And the first interpretation of financial performance is the cash flow performance of a company. There's also the term of financial performance regarding stock prices. We also will use this interpretation later. Okay, so the first two hypotheses kind of claim an inverse relation that says once there's financial performance, then there's, so first there's the financial performance and then there's the corporate social performance. The first is managerial opportunism, meaning that if the financial performance is weak, then the managers try to placate stakeholders by doing some corporate social stuff in order to kind of hide the bad financial performance. That's one hypothesis. The financial slack hypothesis is just the opposite. Like as it says, if the financial performance is good, then the managers can afford to do corporate social responsibility. But both of these hypotheses are kind of measure financial performance and corporate social performance in a contemporary basis. And the view that we want to follow here rather is that we first have some corporate social performance, and then later some financial performance results from that. And the trade-off theory here says that it's a trade-off. So if you spend your money on corporate social responsibility, then your financial performance goes down because it's costly. It's a trade-off theory. And the good management hypothesis, which is of course the most interesting here in this context, says that if you're doing some corporate social performance that we can measure by ESG, then later a higher financial performance results from that. That's a good, because it's good management to do that. Okay, and we will look at this hypothesis. Okay, so but if we really observe a good financial performance, and this is now meant in terms of stock market returns, which is kind of the second interpretation of this term. So if we have good returns, positive abnormal returns of a company, after there has been a good corporate social performance before, then this could be an indication of the good management hypothesis, but not only. This could come from additional demand. That's the additional demand explanation, which simply says that many investors want to have the few companies with the high ESG scores. And then we have a bubble-like demand that generates high returns. And these high returns are not underpinned by corresponding financial fundamentals. So that's kind of only a demand effect. And the second is more the good management hypothesis. The second says, no, the high corporate social performance generates intangible assets of opaque nature. And later, after some time, this intangible asset realized through additional cash flows. So that's really the good management hypothesis, which then in turn cause abnormal stock returns. These are now covered by financial fundamentals. Okay. So what we've done empirically is you have one study that really utilizes these three different ratings, and that what we have found here, and now redoes some well-known studies that have shown previously, so other studies from other researchers that have shown some positive correlation between ESG and positive stock market returns. And we redo these studies with the three different ratings. And it turns out that these previous findings from previous literature are not stable, because if we use the ESG scores of another provider, then the results are not there anymore. And if we look at the effect in another period, in a later period, the the effect is not there anymore. So this says, okay, although some studies have found some short-term relations between positive ESG and stock market returns, which may be some indication of good management, but may also be explainable through the other hypotheses that I've shown you. But still, this effect is not so clear if you use another rating provider. So that's rather a negative finding. But of course, this motivated us to look at the long-term returns. So really at the good management hypothesis. And in another study, we looked exactly on that, on the long-term returns generated by CSP efforts. And here we use the different subcategories that we have, namely resource reduction, emission reduction, product reduction, innovation, which is in the environmental dimension, work for society, customer in the social dimension, board of directors, shareholder rights, vision and strategy in the governance dimension. And here we employed observations of 1,278 firms from the USA and Canada over the years from 2002 to 2014. And unlike many other studies do, we considered here really the long time buy and hold returns. That is, stocks are really held over a period of up to 5 years and not swapped after 1 year, what is implicitly done in many, many other studies. So that's really a research methodology that is aimed at looking at the long-term effects, really. And the results are, although the additional demand explanation cannot completely be ruled out, there are some clear indications for the additional cash flow explanation. That really means that after quite a while, you start to generate additional cash flows that then make the stock prices rise. And we found that resources and emission reduction perform well in the environment dimension, workforce and society perform well in the social dimension, and in the governance dimension, we do not find any certain aspects that really lead to a higher abnormal return in later years, and it's up to 3.8% here. Okay, so very interesting finding. The next thing I would like to talk about is the credit risk of a company. Does ESG also have some influence on credit risk? And we have 2 studies here that explore the relationship between environmental and the social dimension. That is ESG, but without the G, on the one hand, and credit ratings on the other hand. Okay, both studies explore regional differences and quantify the influence of the ESG scores on the credit ratings as issued by a classical rating agency. And so this, of course, has to do with debt financing costs. Okay, the first study focuses on ES as the overall score, but without G, and the E dimension and the S dimension. And looks at the case of Europe versus North America. The data employed here are asset 4 scores and S&P credit ratings of 942 firms over the years from 2002 to 2017. And the main innovation here is that we are also doing out-of-sample analysis, and we look at marginal effects in a so-called credit risk model. The main findings here are environmental and social ESG scores have, so if they are high, have a risk mitigating effect with respect to credit risk. So credit risk can be lower than if the scores are higher. In North America, E and S have a lot of variation and can explain the variation in credit risk. In Europe, we only find the S score to be significant. So that's first indication that we really can derive something out of that. And in the second study, we look at the things more detailed. We establish a 2-stage model with a more causal explanation. We have 3 regions now, namely Asia, North America, and Europe. And we look at 10 subdimensions of E and S. You have seen these before. So these subdimensions that are out there. The data employed here are more than 7,000 yearly observations from over 1,200 firms. We have asset 4 scores and S&P ratings over the years from 2002 to 2018. The main innovation is that we use in an instrumental variable approach plus a detailed analysis of the drivers of the credit ratings. And our main findings here are that product innovation is highly significant. That's an environmental dimension. Product innovation is highly significant in every region and lowers the credit risk. And diversity is also significant, but only in North America and in Europe and not in Asia. So that's really something we can learn from that. So it's really worth doing some corporate social performance in these dimensions, because it can lower your credit risk and you can get better financing conditions. Okay, so the next thing, or the last thing I would like to look at, is controversies. That means ESG controversies, and controversies, corporate controversies, of course. The controversy score constitutes, so to say, a fourth dimension besides E, S, and G. And the question is, what makes up controversies, or synonymously corporate scandal? First, we need to have some unethical behavior, doing harm to some stakeholders. That's the reason why it's an ESG scandal. Yeah. And second, we need to have a public perception of this behavior and an evaluation of this behavior as a scandal. So how do we quantify scandals? With the Refinitive's ESG controversy score. We have ESG related scandals within a fiscal year, and ongoing legal disputes or other effects are sometimes considered accordingly in several periods. So if the scandal is not over, it's still there in later years also. And this score here is a percentile score, meaning that the scandal score is compared to the industry group. That idea is also already familiar to you. Okay, so here's an example of Volkswagen again, Nestle and Wirecard. And we see that once the scandals here occur, so the controversy score goes down. So the lower the score, the more controversies we have. The higher the score, the less controversies we have. So in the case of Nestle, we had several controversies here. So that's very interesting and very, this is just supposed to illustrate that the score really does what it should. Okay, so we have some research on controversies and stock market performance. We ask the questions: do companies with many scandals perform worse than expected? Do companies with no scandals perform better than expected? And the answer is, so I don't have to read out that on the slide here. The answer is, we have a significant outperformance for equally weighted portfolios with a high controversy score. Yeah. And the results are driven by smaller companies. That means small companies without scandals fly under the radar, and they can, on the long run, derive or generate an overperformance, stock market overperformance, due to this property. So in another ongoing research work is current working paper, where we explore which internal and external factors influence corporate scandals. And in a nutshell, we find the following. We have some negative influence, meaning lowering down the number of scandals, from legislative and corruption, which is a country variable, measuring the ability to formulate clear rules, enforcing them effectively, and the creation of a low corruption environment. Also, the ability or desire of a society to avoid uncertain situations. Both are country variables that lower the ESG, the occurrence of ESG scandals. And the third here is the capital market dependency of a company. So if a company is more dependent on the capital market, it also has lower tendency to have scandals. Positive influence comes from the following three: from the societal orientation towards individualism. Yeah, then we have more scandals. From the company size, because the company is more visible then, or has more departments where some scandals can occur. And interestingly, if the company has a high ESG score, then it's also supposed to have more scandals. as well. Okay, so let me come to the conclusion. Time is running out. I have some major takeaways from a company perspective in 4 theses. Thesis 1, take care about your E, S, and G score, but regard it as a long-term investment and make sure that it has a positive NPV. You should also take care. Not all investments in the E, S, or G score are really rewarding to the same extent. Thesis 2, consider which ESG rating providers really matter for you. We have seen that they do not converge naturally. So you may choose those providers that are mainly important for you and your stakeholders, especially your stakeholders, of course. And I would say good ESG behaviors should always lead to a better ESG rating, regardless which provider you are looking at. Thesis 3, striving for a high ESG score may also decrease your credit risk and thereby improve your financing conditions. That is also something that we have seen, but the effect depends on the context, the region you are located in, or your industry. And thesis 4, try to avoid ESG scandals, but the higher you fly, the easier you might fall. Yeah. A high ESG score can serve as a short-term buffer. Yeah, that's a good thing. But in the long run, if you are having ESG scandals all the time, then your ESG score will also go down. Okay, that's it from my side. So if you have any questions, I'm happy to answer. And here are the references of the research that I have talked about. Thanks.